question is now, what do you need to take the market lower? And this is more of a nuance, but when you look at companies that are now quote unquote cheap, right? Let's take an example like we hear a lot about Google or Facebook, right? And people will say, my gosh, this is cheap. Because if you run a screen on it, it's like 10, 11, 12 times price to earnings. Well, the price because you can look on the screen. The real question is, are the earnings right? And the thing that can take the market lower is if you actually think earnings are modeled incorrectly, right? So we saw it this week as well. Snap, completely just blew themselves
46% down intraday yesterday, I think.
I just want to say something about
in
Snap.
One day.
They have the most incredible propensity to self-immolate on earnings calls than any other company I've ever seen. There's probably been 3 times, no less than 3 times over the last 4 years, where I don't know whether it's just poorly scripted or not well rehearsed, or the people that are helping Evan get ready for these things, but these are disastrous calls. Facebook's had a couple in its lifetime, but Snap consistently, probably once every 18 months, will do this. Anyways, the thing just completely implodes. The stock implodes by 48% or something. And then it, rolls over to companies like Facebook and Google, who then are off 8 or 10%. My point in telling you this story is that if you think Facebook and Google, just as an example again, are cheap at 10 times, well, you better hope that the earnings are right. Because if the earnings are actually wrong, that's actually 27 times and 19 times. I'm making these numbers up to give you the example because the earnings are fundamentally wrong. So that's the risk now that's left in the market, in my opinion, that could take it much, much lower, is if that, all of this slowdown really contracts spend and the earnings are actually not accurate. The forecasted earnings will need to be revised over the next 2 or 3 quarters. And that's where we will probably see the low. If, however, growth is muted and the Fed can, as Brad said, it's a really good analogy, now just course correct by degrees, a degree here, a degree there, we've probably consolidated the lows.
So said another way, we look at a company like Snap or Google, a lot of their expected value has to do with people's ad spend. We now see less homes being sold, so maybe people in real estate stop spending less on ads. They're a major advertising category. Maybe direct to consumer. People are not buying because of supply chain issues. This stuff is too expensive, and we're not going to spend on ads. And so all of this ad revenue, that's some of the first to come out of people's budgets. So, even as great as Snap's results actually look, they were up 38% year over year. They're generating over $100 million in free cash flow.
The guide was terrible because what they said was our earnings are not modeled accurately.
Right.
And so that's the risk that you now have to take to every company. You cannot look at a screen at Yahoo Finance or Bloomberg, look at a price to earnings ratio and say, wow, 7 times, that's so cheap. It may not be 7. You have to do your own work. It could actually be much higher than that because the earnings may be at risk.
The earnings being at risk is this contagion that we talked about, I don't know, 6, maybe it's like we're going on almost a year now, Sacks. We talked about a contagion happening because we've all experienced it in the last 2 recessions, the dot-com bust and the Great Recession. So what are you seeing in terms of at companies, this contagion risk? Are people canceling SaaS contracts on the margins? Obviously, people are doing hiring freezes. Obviously, people are laying people off. Are people going to start renegotiating salaries? What's the next couple of shoes to drop here, Sacks? And that would signal to you a true bottom here. Like, have you seen, I thought maybe one would be if somebody offered somebody an investment with a 2 or 3 times liquidation preference. Have you seen one of those yet? Have you seen people say, we're going to renegotiate salaries? Because that's when it was really dark, right? The last 2 times.
Yeah, no, it's going to take time to get to that point. I mean, where you start seeing structure in deals is when a founder is trying to preserve a valuation they got last year, and that can't really be justified, but they don't want to just take the down round. So you try to preserve the optics of the last round by building in all these preferential terms. We don't like to do deals that way, but you'll start to see them happen later this year when companies get more desperate. That's not the first thing that happens, though. I think that to your point about the talent market, it's definitely going to happen. Has it happened yet? No. What has to happen is first, all these open recs get canceled. Companies freeze their hiring plans. Then eventually they do layoffs. That's coming. And then the talent market
here.
cools down.
Both of those things are here. Both are here. So what's the next in talent wars?
Well, yeah, I mean, look, but within the next 6 months, the talent market's not going to be as hot. And, in the same way that startups aren't getting 10 term sheets, now that maybe they get 1 or 2 if they're a good company. Same thing with talent, right? They're not going to have 10 job offers. They might have 1 or 2, and that's going to create, that's not going to create the same continuing upward pressure for increases in comp. To your point about will SaaS contracts be cut? I mean, I think software is pretty sticky. I mean, if it's a good product, will deal cycles get longer? Yes. Will there be more mortality risk in the startup or SMB customer bases of companies? Yes. I think one concept that startups may want to wrap their heads around is what I would call deferred mortality risk, meaning that during the last few years, during the boom times, the graduation rate from C to Series A to Series B was very high, perhaps artificially high. So there's a lot of companies that got funded and advanced to the next round, where in more normal times, they wouldn't have made it. So
got it.
Now, if those companies haven't really fixed their issues, they've just deferred the mortality. So I think all of us probably in SaaS land need to be modeling out higher logo churn for customer bases that are skewed towards startups or SMBs. And we don't know what those numbers are going to be yet, but that is likely to happen.
I think that's right. I think the other thing is that there's a lot of companies that are going to have to get religion on free cash flow conversion ASAP. And I just think that most CEOs, to be very blunt, are poorly educated and innumerate. So their level of numeracy to even understand this is pretty poor. And most board directors are equally.
Can you unpack it right now? What does it mean to get the business to free cash flow? What does it take? Why is it important? And how do those businesses look differently to the market?
To spend less than you make.
Okay, hold on. I just want to make sure I got it correct. You make money, but the number of the money you make is higher than the number of the money you spend. Got it. Okay, and then there's a delta there. There's some difference between those two numbers. And that number is important to some people, is what you're saying.
I think increasingly getting that number to be greater than 0 is going to be really important. It allows you, again, everybody starts to throw out this whole thing, which is, oh my God, you can never slow growth and the company will die. And yeah, maybe in a vacuum that's true. But when every other company is fighting tooth and nail to survive, the only thing that you need to do is actually survive. By surviving, you win.
Yes.
And if you can basically make your cash last as long as possible, even if you cut to the bone and stop growing, if you come out the other end and you're the only company that's left, you will win and run over the market. You may have pushed to the right a few years your plans of world dominance, but they're still available to you. It's the company that foolishly thinks that they can continue to spend money at the same rate or in the same ways that are going to learn this hard lesson. Because I think that investors are not going to tolerate being able to, provide incremental capital to organizations, funds, who are then, misallocating that capital to basically support a poorly marked portfolio. And I think that is going to be the real come to Jesus that actually makes all of this thing come clean. Like pension funds, family offices, endowments, all these organizations are smart enough to realize that they're giving good money after bad if what those folks are going to do is not demand portfolio rehabilitation and instead are just going to basically keep the marks of their old funds because they're just in a game of waiting it out. Where the hope
taking action greater than, blind hope and just going, steady doing what you've been doing. You got to make some changes.
I mean, look, I love Brad's reaction. I think that most growth-oriented funds are looking at their portfolios and they're trying to balance two strategies. Strategy one is get into massive rehabilitation mode. The problem is most of these people have never built or run a company, so they have no idea how to rehabilitate anything. They're, market momentum folks, and in that they were excellent. But in actually helping CEOs build and rebuild a business, I think that they're not as well suited. Doesn't mean they can't do it, but they're not as well suited. That's path A. But I think that path is very painful, and it requires you to take medicine, the bitter medicine, which is to basically mark your portfolio down 50 or 60%. Just like the public market terminal valuations have gone down. The other alternative is to basically raise enough money to do, for example, unpriced converts into those same companies so that you don't have to remark, so that the auditors will be allowed to carry these fake valuations. You can maybe mark it down 10 or 15%, but you don't have to mark it down 50 or 60%, and hope the market returns to its previous state. But as we've all talked about, that previous state is probably unreliable because it was a moment where we had a global pandemic where we took rates to zero and we printed $9 or $10 trillion of excess liquidity that inflated these things. So I got to think that, prices in 2019 were a little bit ticking up. 2020 were really ticking up. 2021 was egregious, and 2022 is where it all comes home to roost.
Brad, explain to us. We hear free cash flow, we hear income, net income, EBITDA. We hear all these terms. Now, free cash flow is what everybody is focused on. I believe that seems to be the predominant rallying cry in a lot of public market companies now. Can you explain to people what the difference between these things are? Because people kind of bundle them together. Why would somebody like Dara at Uber just say, hey, we've been talking about adjusted EBITDA, income, net income, all this stuff, but free cash flow is what we want to focus on now? Or is that correct? Yeah.
And our friend Bill Gurley rails on this adjusted, and look to your left, look to your right, adjusted one more time, EBITDA, right? Like in markets like this, what people want to know are what's the green stuff I can take out of the business and put under my mattress? Free cash flow, distributable free cash flow. And not only that, how much per share? I think the single biggest issue growth investors are focused on today is the easy way out for all these companies. They'll tap down a little bit on their hiring, they'll tap down on their spend, but out of the back door, they want to give a bunch of free stock to employees to help offset that pain. This is really important to understand because stock is a real expense, right? When a company goes public, the more shares you have, the lower your price. So it is a real expense to everybody, the founders, the employees, the investors, right? And so what I think the single biggest conversation going on in boardrooms in Silicon Valley today is, hey, can we have a little bit more stock this year, whether it's options or whether it's outright RSUs, to give to employees? Because if we don't give it to employees, they tell us they're going to leave. This is a real hard truth. I had a CEO of an incredible company call me and say, listen, we pay our engineers $1 million a head, but we give them stock that over the last 5 years has been worth another $1 million each year. So they built their lives as though they had $2 million a year in income. They bought a house, they bought cars, they sent their kids to private schools based upon that $2 million. And now when we tell them that this upcoming year, we're not making whole on that million. It can't be when we win, you win, and when we lose, you win. So the tough conversation is we're not re-upping you because the stock's been cut in half. And so now that engineer is saying, yeah, but this year that means I'm only getting paid 1.2 million. And the answer, the tough answer is yes, right? Shared sacrifice. You should have never assumed that was going to be worth an incremental $1 million a year. But that takes leadership, that takes courage, that takes a board that knows what they're doing to explain that over the full arc of that employment. And the first thing the mercenary employee says is, well, I'll just go work somewhere else. Mm-hmm. And the right answer for a good leader is okay. If that's your approach to this business, then you need to go work somewhere else.
I mean, you just did a great test, right? That's a great filter. You're a mercenary, and you were with us when we're up, but you're not with us when we have to take some austerity measures. Is this the end of entitlement across the board, Sacks? I mean, we had an entitlement class. Everybody thought they could raise a VC fund. Everybody thought they would have 100% IRR because they would just buy NFTs and flip crypto projects that had no released product. And the same with employees. They just thought, I can just keep, raising my salary X amount. And now it looks like Apple said everybody comes back to work 3 days a week. And we don't see a lot of people quitting Apple because there may not be another option. And maybe a lot of the firings that are occurring, I'm thinking of Cameo here, had three of their top 6 or 7 leaders leave. I interpreted that as maybe they had really big comp packages. And when they did the layoffs, they said, you know what? The number 2s in these positions can get the job done for a third of the price. maybe that's better for the business. So is this the end of austerity, the end of entitlement?
I think so, or a lot of it. There was a great article here that came out recently about Netflix, where Netflix, they're finally getting real about their kind of their woke entitled employee problem. And this is in the New York Post, but there's many other newspapers that covered it. Basically, it says here, Netflix tells woke workers to quit if they're offended. If you find it hard to support our content breadth, Netflix may not be the best place for you, said the memo. So,
period, full stop.
Yeah, they're just sick of it. They're just not going to put up with it anymore. They're sick of being held hostage by their employees who think that they can kind of muscle the leaders of the company by starting a petition or boycott campaign every time they want to drive the company in a certain direction. And so I think companies are finally figuring out this is the only way to react to basically being held hostage. If you don't like it, quit.
If you don't have 7, 8 job offers, and recruiters calling you constantly because everybody's on a hiring freeze, well, then maybe people will appreciate the contract of I work for you, you give me money, and then everything else is superfluous. On that note, did anybody see the Ricky Gervais Netflix special yet? If not,
is it on Netflix?
It's on Netflix. It's unbelievable. I mean, Dave Chappelle, in terms of bravery, Ricky Gervais was like, I've already made my money. I'm burning the whole building down. I mean, he went full equal opportunist. And I mean, I think the trans issue became like 10 or 20% of his latest special. So it does seem like the comedians are saying, you know what? We're going to make jokes. We're going to make jokes about everybody. We're not going to buy into this. You can't cancel us. We're just going to keep making jokes and we're going to keep making money. And that whole concept that, people are going to be held hostage, I think is over. Independent of what you think of making jokes of, various marginalized or smaller groups of people.
Can we just go back to something Brad said a while back about how Manchin saved the Democratic Party? Because I think there's actually an interesting point there.
Yeah, unpack it.
Yeah, such notorious right-wingers as Jeff Bezos have said something very similar lately. When do you see that? Where Biden tried to blame billionaires for the inflation and Bezos was having none of it. He said, no, listen, it's not because of us or our companies, it's because you printed too much money. And he said Manchin saved you from yourself because it would have been another $4 trillion of spending on top of all the other trillions of spending that we had last year. So it's absolutely the case that if the administration was left to its own devices, remember, they were touting back in December, they were touting the idea that this $4 trillion of Build Back Better spending would somehow be the cure to inflation. Imagine if they had poured that gasoline onto the fire. I
mean, we would go to 20% inflation. We might have had a currency like a serious currency issue, no, Chamath?
Yeah, but hold on. But let me just finish the point. I don't want to just make a partisan point here. There's a serious economics point here, or learning. I hope our policymakers learn from this, which is what happened over the last couple of years. We had $10 trillion of money printing. Right? Why did they do that? They thought that they could stimulate our way out of this COVID recession that they had induced with lockdowns. In any event, the point is they thought they could stimulate economic activity by printing money, and maybe cynically, politically, they thought it would be good for them in the midterms. What actually happened? That $10 trillion goes into the economy, but there's no corresponding increase in the output of goods and services. So 2 things happen. First, price levels rise and we get inflation. And second, we get an asset bubble in the stock market. And then the way both those things sort of come crashing down to earth is the Fed looks at this inflation and suddenly has to jack up interest rates. That pops the asset bubble. It vaporizes something like 14% of global wealth. And then simultaneously, workers feel a lot poorer because their wages haven't kept up with inflation. So this whole idea that you can just print money as a way to create wealth and prosperity, I hope what we take away from this, I think, recession that we're going into is that is not a viable strategy. The only thing that creates wealth in a society is the output of goods and services that people want. And you just can't try to sort of play games with that by creating this sort of phantom money that doesn't represent a real increase in goods, services, or productivity.
Yeah, it's hard for people not to take this all as partisan, but if you just look at the objective facts, the last 2 administrations have printed money like drunken sailors, and it's a mess right now. So you can divorce yourself from any conception that this is partisan. Trump spent a shit ton of money, and so did Biden. And who's more qualified than Trump and Biden? Elon, Bezos, the people who appear on this podcast. We have much more of a pulse on what's happening in the actual real economy and in entrepreneurship and capital allocating than these people. And I love the fact that now, Bezos is a shit poster. He just doesn't care. I think we're having like an honest discussion now, right?
One of the areas where I don't think Elon gets enough credit is when he explains macroeconomics. I think he actually really understands what an economy is. I mean, an economy is basically a trading system for the production of goods and services. If you were to go, this is a point he's made, if you were to go to a desert island and somebody just gives you $1 billion when you're sitting there on that island, you can't buy anything. It doesn't make you wealthier. What makes you wealthier is the production of goods and services that people want. And that's ultimately what an economy is. Money is just the accounting system. The dollars is just the accounting system. If you start printing lots of money, all you're doing is debasing the accounting system. It doesn't make anyone richer. And yet, the way that conversations around economics really take place, the only thing you ever hear about is stimulating demand. You never really hear anything about production. And I mean, this is an old debate that goes back to the 1980s about, supply side economics. But regardless of what you call it, wealth ultimately comes from our capacity to produce goods and services that people want.
That's a great point.